Thanks for tuning into the All Funds Network podcast. My name is Mike Schroeder. Today we're here with my co-host Skyler Steinke, and we are joined by Sam Gaer. Sam is the CIO of Monarch Asset Management's Directional strategy. He brings decades of experience across NYMEX, FINRA, BlockTower, building marketing infrastructure and trading strategies at the intersection of TradFi and crypto. So, Sam, thanks so much for joining us, man.
Oh, it's my pleasure. Really excited.
We got a lot of great topics today. We're going to be talking about institutional investors, kind of moving into the crypto space. We're going to be talking about the funds that you guys are operating, what you're doing that's unique here, how the industry is maturing, digital asset treasuries, and more. So, Sam, maybe we just start with your background. You've got a very interesting background. You've worked at a lot of the major traditional institutions, as well as some very large ones in the crypto space. So yeah, maybe just kick it off with your background.
Sure, I'll be relatively brief because it's relatively long background. But so I'm at Monarch Asset Management right now. We're a quantitative hedge fund crypto space. Prior to this, I was at BlockTower, where I was a co-portfolio manager of the flagship $250 million fund. And prior to that, I was operating my own fund. It was called Katana Financial. And Katana specialized in, at first, volatility. And we started dabbling in crypto in 2018 when we became the first market makers of CME, Ethereum, and Bitcoin contracts. And then things kind of evolved from there. We were very, very large VIX traders. Sometimes doing as much as 10% of daily volume in VIX, traded through several different crises, everything from Brexit to Volmageddon to through the pandemic. And at the beginning of the pandemic, as we were making markets in the CME Bitcoin products, I started buying spot Bitcoin at about 7,800 or so, figuring, hey, what can I lose? $7,800, right? And then from about 2021 on, I'd straddled both worlds. When in early 2024, I had this epiphany, and my career is kind of marked with these epiphany moments, if you will, at these pivotal moments, paradigm shifts in the industry. And the moment of clarity I had was, it's the beginning of 2024. There's an election coming. There's no better time right now than to be in crypto. I had a thesis on the election that actually, no matter who won, you'd have a more friendly regulatory environment, macroeconomic tailwinds, the usual story. And then I also believed it was generational, in that I have kids who've grown up without ever knowing a world without the internet, and for the most part, them and their friends are very comfortable with digital currency and payments via apps, et cetera. And I said, these are the people who are going to be making decisions in the next 5 or 10 years, and as such, it's an evolve or die moment. So prior to Katana, I held some positions in the industry which are pretty notable, and also again, the theme of my career is being at these kind of paradigm shifting moments. I was at FINRA from 2010 to 2012, where I was the chief information officer, ran a very large technology operation there. Most notable, they're one of the largest data processors on the planet, and started their migration to AWS. Prior to that, I was at New York Mercantile Exchange, or NYMEX, where I was the CIO, Chief Information Officer, and then went to London for 2 years to be the CEO of NYMEX Europe, and came back and was the EVP, which is the functional equivalent of COO. Led a lot of the deal making in the $9 billion merger with CME. Went through the IPO, which was a record at the time. And the system that I had sold to NYMEX is called the Clearport system, still in production today. So I'll stop there. But the last thing I will say about my career is I started as a floor trader, which is why you don't see my hands right now, but they are moving. The floor kind of stays with you. It was a wonderful, wonderful time to be a trader. But things evolve and markets move. And as I said before, you either evolve or die.
Yeah, that's very cool. Yeah, great background. Thank you for sharing that. The part that like I'm most curious about is the transition from FINRA to Katana. Can you tell us a little bit about that? And then I want to get into your crypto story too, because it sounds like your crypto story was the CME futures, but yeah, I want to hear from you.
Sure. So I got a call one day after NYMEX. I was partners with a gentleman who was one of the founders of Virtue in a high frequency energy arb firm. And just out of the blue, got a call one day from the CEO of FINRA, Rick Ketchum. And generally, when you get a call from the CEO of FINRA or chairman of FINRA, usually it's not a good thing. But Rick and I had met during I mentioned before we did the NYMEX CME deal, and New York Stock Exchange was in the mix of that deal. And we just kind of hit it off. We remained relatively friendly, et cetera. And he called me and explained that they had some technology issues and they need somebody who's known for execution. And he was offering me the job on the spot, and I said okay. I went back to my partner at the time, and he coined one of probably the most seminal phrases I've ever heard in the industry. So remember, this was 2010, Dodd-Frank, and he says, "Of course you have to go. Regulation is the only growth area on Wall Street." So so I went. I went, and I mean, it was a pretty heavy lift. They wanted somebody to bring in entrepreneurial culture, entrepreneurial methodology. I brought a lot of folks that had worked for me and with me at NYMEX, and we went about transforming the place, everything from these older mainframe data warehouse appliances to more commoditized, rack-based newer technologies like Cloudera, for example, which was Hadoop, a Hadoop vendor, a cloud-based Hadoop vendor. And we were also doing something where we were building a data center and at the same time looking to transition a lot of that compute into the cloud. And so there was this big, kind of like this big job to do where it was not just the technology, but the socialization of change, which again, I'm quite good at. If you think about NYMEX, it was open outcry to electronic trading. And so now I'm socializing this change, but this change was with a board at FINRA, which is about 30 people, mostly from academia, who were incredibly smart people, really accomplished in their fields. And I thought that I did a pretty good job in authoring the first technology strategy that they'd had with a $350 million budget, and at the same time being able to kind of socialize change and explain technology, technology from the technology jargon to the business that everybody wants to understand as to why this is good for us. And so I was there for a couple of years, and the entrepreneurial spirit just never left me. And so I just didn't want to essentially close out my career. I was in my late 40s at the time, and I just didn't want to close out my career as a regulator. And there's nothing wrong with it. It was a wonderful, wonderful place to work with some super intelligent people, very driven and dedicated people, but it's just something that I didn't want to do anymore. And so I spun out and went and built what eventually became Katana.
Yeah,
Decided I was going to build a company the way that I wanted to, with my own two hands, and whatever happens, happens.
yeah, very cool. So you went back to the trading world after being on the floor for years.
Yeah. Yes. Yes. It never left me. Even when I was at NYMEX, we were super plugged into the trading world. Made a lot of great contacts in both in the energy as well as the metals world, and it just never left. And I always wanted to go back to it. And as one of my friends likes to say to me, "What am I waiting for?"
Now the crypto side of that. So what was the crypto bug for you? Was it seeing your son and his friends getting kind of comfortable with obviously the internet and electronic payments, or was it more of the CME launch of the futures?
Yeah, I mean, I think it was like the kids part didn't really come in until recently, about last year and a half or so. Um, it was really the launch of those CME futures contracts, and the real reason why we became market makers was because, remember, we were a VIX trading firm, and the SIBO. I don't think a lot of people remember, but the SIBO had their own futures contracts ahead of the CME, and so because we were on the SIBO, we were making markets in that anyway, just providing liquidity because they asked us to, and populating the book, et cetera. And then I started looking at the CME CFE arbitrage, and being the floor trader that I am, there was $1,000 difference there, and we started doing it, and we had a significant amount of money on deposit with our clearing firm, and I'll never forget, we had to beg them to do more than 5 contracts of ARB at a time because they flat out said, "We don't understand this. We don't understand the risk here. We don't know what this is." And it really reminded me of back in the day of open outcry trading to electronic trading, about that massive fear of change, massive, the status quo, fighting everything that they're throwing everything that they could and fighting that change. And that's where I got really interested because I said there must be something here.
Yeah. Yeah, that's a actually a fascinating conversation, I think, to that point, because going from what you knew back in the past to what it is, I guess now what the new future looks like. There's a lot of push and pull, and whether it be regulations or how things are run from a trading perspective. And maybe you can speak to that too, just how things are different or better, the same, or kind of compare and contrast what the current state is. That'd be helpful too,
I,
because I think there's a lot's changed, right?
oh, absolutely. And I guess you're talking about the state of crypto trading right now. So on the one hand, not a lot's changed from an exchange technology standpoint, which is, from somebody who's been deeply involved in that, it's a little bit disappointing, but at the same time understandable, because it's most exchanges have the mentality, if it ain't broke, don't fix it. And so a lot of exchanges right now are still kind of these, web-based enterprises, because they really want the ability to attract as many people as possible to the platform, who don't necessarily have to have some complicated setup like a front end and a hosted setup like we would have in high frequency trading. I mean, that being said, the market is evolving. I do believe you'll see within the next 18 months, 24 months, you're going to start to see co-locations. You'll start to see a little bit more high frequency enter the marketplace. You'll start to see market makers having to adjust to that. So that's like from a technology standpoint. I think my experience at BlockTower, I really got to see a whole other side of the industry. Remember, I was a high frequency, low latency trader, and I shifted to become an asset manager. And that's a very, very different seat to be sitting in than somebody who's just essentially watching, your P&L tick away all day, plus or minus, plus or minus, plus or minus. And it really gave me better perspective on the industry. And I started looking into it, and the industry from a directional standpoint really hasn't evolved either. So a stat that I like to use from 10x Research, if you had bought Bitcoin in 2017 and held it to now, you're up approximately 565%. Pretty good, right? If you invested in the average crypto directional fund in 2017, you're up about 211%. So therein lies the rub. The underperformance of directional funds is more than 50% of the actual performance of Bitcoin. And so then you have to say, well, why is that? How can that be? Um, and quite frankly, again, if it ain't broke, don't fix it. So for the last couple of cycles where you've had Bitcoin going up and then you've had your alt season, directional funds have kind of been let's buy, let's call it 50 tokens, and hope that they go up. I saw something on Twitter, let's buy it. It looks great. And for the most part, look, I can't argue with success. For the most part, that worked. But the problem becomes, you start getting this lumpy return stream. So one year you're up 300%, the next year you're down 80. Over time, that just doesn't really work and the numbers speak for themselves, but specifically, it doesn't really work for a more mature institutional based investor audience. And so I think that what we're doing is we're kind of out ahead of the pack. Monarch is really fortunate that we have a market neutral fund that's been in business for several years, nearly a decade, of market beating returns. We're recognized as one of the best in the industry from a market neutral perspective. And we have a really deep and well developed technology DNA, which really resonates with me because I am a data first quantitative sort of trader. And we ran a large VIX dispersion book, for example, at Katana. We did some machine learning, trading pattern program, predictive analysis that really that really performed well. And I was shocked to see that that's really not like the norm in directional funds. At Monarch, we have this technology library, and my colleague Boris and my colleague Boris is the CIO of the Boris Ayutin is the CIO of the market neutral fund. And so Boris and I are working pretty closely together to take that library of signals and publish them internally for our use in directional for asset selection, trade entry, risk management, et cetera. I don't think a lot of funds are doing a sort of quantitative, systematic approach to directional, offering what I consider to be an institutional return profile. What do I mean by that? So if you look at some of the larger hedge funds in traditional finance, they tend to offer what I call an 80-20 return stream. We'll capture 80% of the upside of our benchmark, but in down years, we're gonna try and limit ourselves to 20% of the downside. And over time, that return stream starts to compound. So for example, if you gave Point 72 or Millennium $100,000 in 2010, you'd be doing far better than the S&P is doing. And that's because during the down years, they're really managing loss and managing risk on an active basis, more so than if you're just a buy and hold investor. And so we're trying to pattern our directional fund and our return streams and risk management in that fashion. And it's really been received positively. I've been at a number of conferences so far, been received quite positively. And the results actually to date have been positive as well.
Yeah. Okay. There's a lot to unpack. There's a lot of different ways we could take this. The first thing that really jumped out at me while you were talking there was you mentioned going from I believe you said like the data side of the business to portfolio management. Kind of talk about that difference.
Talk about the difference in terms of just the day to day, or
yeah, kind of. I mean, what was the big kind of difference for you there? Because when I think of a portfolio manager, I think of somebody that could be obviously discretionary, managing assets, also quantitatively, but kind of how'd you look at that, and how is it so different on your end?
Right. So it's very different on our end. The way that we approach it is, I should say that we are a systematic fund with a discretionary overlay, in that I've got 30 plus years of experience in the markets, combined with our managing partner and other CIOs in the firm. We have decades of experience in the markets. I can use that to essentially override mostly in terms of taking profit, right? For example, that discretionary piece kind of comes into play when the other day Bitcoin hits 124,000. Our target was 126 to 130 on this move. We had a significant amount of options convexity to enhance our alpha, generate some yield, while harvesting, et cetera. And I decided at that point at 124, when it started to slip, let's reduce our convexity. It's a discretionary. I activated my discretionary overlay, and we took off about 50% of our options portfolio in Bitcoin, left it in Ethereum, and the results turned out to be pretty good. And so, from my standpoint on the risk reward of that, why is that really important? Well, that's really important because if the market keeps on going and I'm wrong, I hope I have to explain myself to my colleagues, and that this is the worst trade I ever made. So how is that different from trading like a high frequency, low latency, ARB/dispersion style of book? It's really the lens that you're looking at investment time horizon and risk through. So if I'm running a high frequency, low latency portfolio, I'm literally looking at what are my results today? What are my results in the last hour? Show me how fast my system is. Where am I slowing down? Where am I missing bids and offers? Where am I dropping legs? And where am I bleeding? Where am I making money on a day-to-day basis? At the same time, I'm focusing a lot of resource on compute, on right now it will be on AI. I'd be focusing a lot of resource on latency profiling, on hardware tuning, network tuning, routers. Really, just a lot of minutia to eke out that extra. I mean, we used to celebrate when we found like an extra 100 nanoseconds, right? And in crypto, you're talking about hundreds of milliseconds sometimes of latency. Um, the difference to me is that I can buy, 50 BTC, and the market can go down a couple of $1,000 even, and I don't even have to. I don't think about that in the context of the lens that I'm looking through. Is I'm not looking to get rid of it today. I'm not looking at this as an arbitrage. I'm looking at this. It doesn't really matter to me if I buy Bitcoin at 116 or 114 if I think it's going to 150 or 160. And that's a really different way to run your trading operation. Quite frankly, I think it's a better way to live. So um, I'm pretty happy I made that switch. But at the end of the day, what this translates into is scalability. So most market neutral / high frequency / arbitrage funds eventually run into a capacity constraint. What does that mean? Well, ARBs can only take so much liquidity. There's only so much of some sort of special structure that's out there that you're trading. There's only so much of it that's going to trade on a particular day. That the more money you apply to it, the narrower spreads get, and you just start diluting your own returns. From a directional standpoint, think about applying a lot of that methodology to asset selection. Using a combination of AI and machine learning and our signals for asset selection, early detection of alt movements, options selection, super important. What options am I going to select? Where on the curve do I want to be? What's the sweet spot? Where do I want to be? So when we start talking about the book that we're building, we're looking to scale to 100, 500 million, $1 billion, with very little change in how we're approaching the market, very little change in asset selection and the assets that we are selecting, and very little change in slippage, quite frankly. And so, it's very rare to find a market neutral strategy that's going to have that sort of scalability and also appeal to this new class of investors that's first entering crypto in the institutional class of investors. Coming from TradFi, I was once sitting at the table where we were at our height, we were about $80 million fund. And I was once sitting at the table with somebody who was like, this is great. I really like this, but the minimum check size we write is 500 because otherwise it just doesn't move the needle for us. So I'll give you one more stat and then I'll shut up, but
this is good.
I'll give you one more stat. And so back in April 1st, when we had Liberation Day week, where Trump came out with his tariffs and markets had a big tantrum, the tariff tantrum, equities that week lost $5 trillion in value. That was nearly double the entire market cap of crypto in 1 week. Equities lost that. So equities and bonds, I should probably say. And so you have to understand the scale in which we're playing right now. Crypto is a very, very small part, still important part, but very small part of the overall financial ecosystem, which I wake up and I smile every day because I just know that I'm early.
Yeah. That's exciting. You said a couple of things, Sam, which I thought was kind of fascinating. One, the new class of investors that you're going after, what that looks like. Maybe start with that. Break that out a little bit for our audience. What does that mean to you when you say new class of investors? And we'll get into that a little bit.
Well, so prior to this administration coming in, crypto's never had a really friendly regulatory environment, for lack of a better
Right.
word. And that's prevented a lot of traditional larger investors from coming into crypto. Um, and on top of that, digital asset treasuries, which I'm sure that we'll speak about later, digital asset treasury vehicles are now broadening the appeal and broadening the availability of crypto exposure to a whole new audience. If you're an endowment, for example, endowments might not have the mandate to trade crypto. And even if they do, they might not want the complexity of crypto rails, of opening up a Coinbase account or a Kraken account and managing custody, et cetera. And so there's, as I mentioned before, we're a tiny part of the financial ecosystem. The whole rest of the financial ecosystem is saying, wow, I gotta have access to this hyper volatile asset class. I can go through all the macroeconomic reasons why you want to own crypto right now. Everybody probably tuning into this podcast already knows that, so I won't bore you. But um, institutions are looking to place money and to place bets on the table and get exposure to this asset class. And so limiting factor has been regulatory, but quite frankly, it's also been ourselves. As an industry, we've generally directional funds have not really have not really behaved in a mature manner or a mature fashion in the context of managing risk and delivering consistent stream of return to investors. Most market neutral funds have done that very well, as has ours. Shameless plug. But from a directional standpoint, it's been very difficult. I mean, partly because, let's call it what it is. This has been a hyper volatile asset class that is now first starting to mature. Volatility in Bitcoin, I like to say 40 is the new 60, and 60 was the new 80, right? So these are all signs of a maturing asset class, and it's attracting more capital from the sidelines who wanted to participate and who now have a mandate either through regulation or just through the ability to access through the equity markets.
Yeah. Well, it's exciting to see, obviously, the new entrants in the space, new types of investors coming in. Uh, you said something earlier too. I'm curious now because we've all been in the TradFi industry for a long time, got into crypto, digital assets. What is your your colleagues that you've known for a long time? You mentioned the fear of the unknown early on about the space. What do they say now to you?
I like to call it people are very crypto curious. So, and again, I'm not the, I'm not of the average tenor of most folks who are in crypto. Most are, a little bit younger than I am, let's say. And so, when I'm going to parties or when I'm hanging out with friends or just, playing ball or whatever, um, people ask, hey, tell me more about this crypto thing. And of course, everybody says, tell me more about crypto. Everybody really means Bitcoin. So like, I don't even go there with alts and Solana and different, I don't go there. And so I start talking about but I don't understand it. Why do I have to own it? And really, why is it not a scam? And why? And what I found, honestly, again, we have an education problem, if you will. But realistically, there's a whole segment of the population that doesn't understand crypto, but are curious. And from that standpoint, it becomes, on the one hand, it's a little difficult to explain if you're kind of set in your ways. But then on the other hand, I basically say, look, if you want to wire money from your bank account to, and I point across the table with somebody else, to your bank account, and you want to give somebody X, right? Let's say $1,000. You've got to go to your bank. You've got to say, okay, I need to wire this. Now you can either do it online by with a few clicks or not. But ultimately, you're gonna spend, I don't know, $10, $15, $20 for that wire when you can do it for fractions of a penny instantly right here at this table with no middleman. How does that sound to you? And they start saying, huh, really? Tell me more. And that starts the conversation. So um, there's nowhere but up for all of this. And like I said, for me, this was generational in that not so much people of my age and my experience, but people who are coming up right now, who are new to the industry, who are new to trading, who are new to art or fashion or whatever, have really embraced crypto, and that's just going to keep increasing. One story, when I was at BlockTower, we had a venture fund, and I was fascinated because one of the big investments that we had touted at our investment day last year was essentially the tokenization of artwork as collateral for loans. So in the art world, you can typically go out and borrow against your art. It's a really kind of opaque process. There are only a few lenders who will do it. And this one company was really into, they're really first in terms of tokenizing art. And that got me because I'm like, this is so much broader and will be so much broader. And we're just at the beginning. It's so much broader than just trading Bitcoin, right? And we're at the beginning. We're early innings, and as you could tell, I'm pretty excited about it.
Yeah.
That's great.
Let's talk about your funds. So you guys are currently operating 3 different funds, yeah?
Correct. So we have the market neutral fund that I mentioned before, which I would consider our flagship fund. We have a Bitcoin fund, which is generally a Bitcoin yield fund. So it's Bitcoin denominated. And so, for example, if you're a holder of Bitcoin and you want to generate yield, we're pretty good at doing that. And then we're also running my fund, which is the directional long short systematic with discretionary overlay. On top of that, we have some intersectionality between the 3 funds, and that we have this kind of little burgeoning, I shouldn't say little anymore, but a burgeoning digital asset treasury business where we not only invest in a lot of digital asset treasuries, but we also end up becoming the asset manager for the treasury in terms of generating yield and staking, et cetera. In no small part because of our relationship with FalconX. FalconX, as I'm sure you know and your audience knows, acquired a majority stake in our GP in late May, and it's been a very fruitful relationship from the perspective of it gives us a seat at a lot of tables, specifically in this digital asset treasury trade.
Yeah. So with your funds, kind of talk how have the strategies kind of evolved over the years? Maybe sticking with like the market neutral fund, because that's, I feel like as a lot of institutions have come into this space, that's typically maybe the first place they look. But talk to us about kind of how that environment has changed over time.
Sure. Yeah. I mean, it's the first place they look because, quite frankly, it's the easiest thing to understand. So if you're TradFi, you can really understand a relative value trade, right, or a stat arb trade. And so that's really how market neutral started out. I'm going to do some perp arbitrage. I'm going to do some relative value trade. I'm going to do exchange versus exchange. And that's really given way to kind of more advanced modeling, which is where I would say our sweet spot is in the context of running some pretty complex stat arb matrices. I think Boris runs at sometimes 80 different symbols in his matrix, which is a pretty big one. And at the same time, we also do some market making for new projects, liquidity provisioning, some delta scalping, delta gamma scalping, delta trading, and then as well as a portion of our debt business goes through market neutral in terms of we are pretty good at being able to hedge out activity. And finally, we do some. I'm going to call it semi-liquid staking in terms of being early on some projects and then just being able to hedge out that exposure.
With the Bitcoin denominated fund, now that one's interesting because, like, to your point earlier, a lot of these funds that have been mostly discretionary have significantly underperformed relative to Bitcoin. With the fund strategy like this, you're technically competing against Bitcoin. You're trying to stack those sats. How's the market, reception been?
The reception to that's been excellent. We're managing quite a bit of Bitcoin right now for holders, for people who've held it for many years who just want yield. They want to hold the asset and they want it to appreciate, but Bitcoin in and of itself doesn't. There's no real native staking, and there's no way to really generate yield. And so we employ various methodology, from everything from some DeFi staking and wrapping, as well as Sanat, who's our CIO of that fund, and also a BlockTower alum, by the way. Sanat runs that fund with an option sleeve as well.
And then the third fund, we'll dive into this one a little bit more since this is the fund you're running, but the long short discretionary fund, or discretionary is not the right word. Talk to us a little bit more about the fund that you're operating.
Sure. So it's long, short, systematic with a discretionary overlay.
Got it.
And again, this is the one that we're really excited about. Clearly, I'm excited about it. In that we believe that this is a very scalable product, offering exposure to crypto, which a lot of investors are attracted to on an institutional basis, because crypto has what we call these big fat right tails, right? Where a lot of right tail price distribution, because we tend to go up. However, most directional funds basically expose the right tail without having any regard to the left tail, meaning downside protection. And so this fund is really patterned to cushion the downside, if not be. Right now we are short a couple of tokens and we're doing okay. And so we can just go outright short if we want to. So it's not a long biased or a long fund like my previous one. We can be long, we can be short, we can be a mix. And it's all really based on, this is the super important part, everything that we do is based on data, and every position that we enter into or exit from is based on a quantitative methodology. So we'll get an entry point, we'll have asset selection. When we're talking about the large caps, Bitcoin, Ethereum, Solana, we obviously we're going to be in, but we get our hedging points, as well as profit taking, stop loss, time horizon, and that all combines to a qualitative measure that I use called level of conviction. And so another key difference in our fund to other funds is that when crypto is making it, when any token is making its new highs, like for example, when ETH was making its new highs the other day, or Bitcoin was making its new highs, as everybody's looking to buy more out of the money right tail convexity, I'm actually looking at the left tail, and some people might argue it's a drag on returns. I'm just looking to protect on the downside as much as give ourselves fairly significant convexity exposure on the right side. We also use convexity to generate alpha. It's a significant source of alpha for us. So for example, one of my favorite positions has been my December Ethereum 10,000 calls. We've been long those for a while. And they've offered great convexity and a great return on investment. But then at the same time, while we're getting that sort of alpha from right tail convexity, we're also generating yield from staking, from basis, from volatility harvesting, which can then finance some of these downside structures that I look at. The downside structures that I look at really come out of my experience as a VIX trader running a dispersion book, where we would construct, when markets were on their highs, we would always construct a volatility structure on the downside of 0 to low cost, which would protect us in the event of a market slide and actually end up making a lot of money. We actually made quite a bit of money in the pandemic as volatility came from 80 down to 40 down to 20. And so I'm patterned. I have a program that I've written that searches out these different structures, tells me what my risk reward is, generates a 3D heat map that I can kind of rotate it. It's a little bit cool, a little bit geeky, but it gives me a real ability to project into the future that if X happens, we can expect Y.
Yeah.
how'd you get the call on Ethereum? That's I mean, it's been a dog until the last 2 months.
So anybody tuning into this podcast who worked with me at BlockTower will probably know that I was not the biggest fan of Ethereum about a year ago. As a matter of fact, that might be a colloquial way of saying that I really did not like Ethereum. I used to call Ethereum the silver to Bitcoin's gold. And who made money back in the day in the trading floor? Who made money trading the gold silver trade? Nobody. So because it's not a real trade, right? That being said, what really informed our positioning there was the flow that we were seeing for digital asset treasury vehicles, which is still ongoing, by the way. Digital asset treasury vehicles. We saw this, and then I also saw ETH trading at about 2,500 with volatility at about 55%, both of which offered a really, really favorable risk reward scenario in terms of what's my downside in price, as well as, okay, we're at a historical low in volatility here, and ETH is not Bitcoin in terms of where we are on the price, on historical price distribution. And so we leaned in pretty heavily as a fund. Our other funds did as well. We bought a lot of convexity at the time. I think we bought the 2,800s, 2,900s, 3,000s, just all the way up. And I decided that I also wanted some longer term convexity that I thought was very, very cheap at the time. And so I said, what's the next real logical level that everybody's going to shoot for by the end of the year? I said 10,000, and we just bought a bunch of them.
Yeah, nice round number.
Yeah. Very cool. Question on my side, Sam. I'm curious because you're also a data guy, right? You're a data guy. You have a background in data and trading. You mentioned AI. You use the different things you spun up internally to solve problems. It sounds like in your business. How do you think about that? Is it easy for someone to kind of utilize, because technology seems to be moving so fast these days? People can use different machine learning opportunities, different algos to kind of vet out their strategy, or even just run their business as an asset manager, right? So I'm just curious your thoughts on that.
Yeah, I mean, it's been indispensable, quite frankly, indispensable. And I would say this, that again, about a year ago, not the biggest fan. But I've watched AI evolve, and specifically in the last 3 or 4 months, the evolution of some of the coding models has been astounding. I built things here in 2 days that it previously took me 8, 10, 12 weeks to do in terms of modeling, just with a coding model. So I'm really using it as a tool rather than as a replacement for other people. But you can't ignore that, like crypto, we are very early into AI. And I do think that ultimately this will be doing the lion's share of our jobs in asset management. But like everything else, as the world has changed, open outcry electronic trading, low latency, click trading to low latency, to ultra low latency trading, to big data, you name the transition. Everybody has been running scared, sky is falling, etc. I mean, this is a much bigger seismic shift in terms of our day-to-day lives. However, used correctly, and if you adapt rather than die, I think you come out ahead. So get ahead of that curve. I think you'll do okay, and that's what we've done here. We're using AI right now in everything, as I mentioned, from coding assistance to I think we're in the final stages of building our own LLM internally for market scanning and algorithms, et cetera, because that's where it's going, guys.
Yeah, it's to your point. I mean, crypto. I mean, I feel like if you're in these emerging, kind of trends, AI, of crypto, you kind of have to be forward thinking, or you have to be adaptable, because that's the pace of change is crazy right now, and in all different facets. It seems like.
Right. Yeah. I mean, look, a real disservice most people do, and I used to say this on the trading floor, right, is that they don't stay abreast or ahead of developments. They don't read and they don't do research. and they don't experiment. They just kind of go about their daily routines every day, and then something catches up and overtakes them, and they kind of wonder why. So I like to stay educated. I like to stay out in front. I've always been on the cutting edge of technology, and I'm going to continue to be there.
That's awesome. I think that what you said, which I think we can echo, the good news of all this is we're early on both sides, right? Both crypto and AI, and it's not going away. It's all here to stay, I would say.
Yes, exactly. And great topics, right? Because you can't ignore the intersectionality of
That's right.
crypto and AI as well. So
For sure.
more to come.
Now let's see. Now, when it comes to digital asset treasuries, are these companies that are going to be sticking around? You know, kind of what do you see in there? You got tipped off on Ethereum early. That's brilliant. You know, kind of maybe just give us a high level landscape of what you guys are seeing in the digital asset treasuries, the DATs
Sure.
today.
Sure. So I guess the first comment I would make is that the Ethereum, the wave, if you will, isn't over. I think a lot of people underestimate the amount of size that's going to be coming to market in the fall, because we have a real advantage at Monarch with our TradFi experience between Shilang and myself. We have a lot of experience trading on both sides, on crypto and in equities and futures. And when we see the deals and the deal structures, we understand this. A lot of people don't. A lot of people think that, oh, somebody just priced a deal, and so they're coming into the market and they're going to buy a whole bunch of, what XYZ.
Right.
The reality is a lot of these deals are pipes or SPACs, and some of them haven't closed yet, or some of them haven't de-SPACed yet. And we're estimating that a significant amount of capacity comes onto market in September, October, November. In the DAT space as a whole, what we've noticed is obviously there is a tremendous amount of deal flow that we're seeing, and the quality varies, I should say. I'm being very nice. We have developed internally a quantitative way to score this, which kind of blends it kind of blends quantitative methodology with qualitative methodology a little bit, and the qualitative just coming from our collective experience. And so there are things that we look for in terms of boards, in terms of leadership of the company, in terms of deal structure, in terms of what the actual business and token is. Lately, what I could say is, yes, there's been a little bit of a deterioration in all of the above. And so you just have to be more selective right now. The nice part about where we sit is we've also been selected to be the asset manager for some of these vehicles that are coming up. I'm sure you heard of the Reserve One announcement. We're ecstatic to be partners with that is just a phenomenal organization in terms of the cast of characters there, specifically the management and specifically the lead investors. And so that's something that we're very, very confident will do well. We were also early to Bitminer. I think Tom Lee has written the playbook in terms of how to do one of these, from everything from his megaphone on CNBC to how he structured the deal and the registration, the effective registrations, and the ATM. If you're running a digital asset treasury vehicle, just take a page out of that playbook. I think you'll do all right. That being said, devil's in the details of these things, and I don't think it's surprising anybody that MNAVs are coming down right now. Most are sub 2, some are trading at par. You can even see arguably some MNAVs go negative. I think that if your case for owning one of these vehicles is an MNAV, I think it's the wrong investment thesis. The case for owning one of these vehicles is that you want exposure to a particular token or a particular basket or a yield strategy that this vehicle is offering, much like an ETF, much like a closed-end fund would be offering. And there's no guarantee of trading at a premium. There's no guarantee of a flywheel. It's nice and it's wonderful when it happens, but the reality is that, like we mentioned before, quantitative strategies and arbitrages, these things tend to go away over time.
For sure. And kind of maybe tell us a little bit about what they're doing with these treasuries. So you guys mentioned you're managing these treasuries. What's the goal? Maybe, take one like reserve one. Kind of what's the goal when you're managing a treasury like this?
Right. Well, I can't comment on any single vehicle that we are that we're helping, or the particular strategy. But what I can say in general is, if you're running one of these, well, if you're running a digital asset treasury vehicle, you're going to have this stockpile of tokens. One way to put them to use is to figure out how is I'm going to get some yield and income off of this to potentially either fund operations, increase my MNAV, for example. So if I'm getting yield in tokens, all of a sudden that's just a natural flywheel, if you will. And so what we do is we borrow from our market neutral and Bitcoin fund in terms of strategy. We borrow some of the methodology there that we employ to generate what we believe are outsized yields compared to the rest of the industry.
Yeah. With the DATs, are they moving the market significantly? Like, is this? And I ask this because when you look at MicroStrategy over the years, it seems like they haven't. I mean, you can make the argument both ways, but like, you see Michael Saylor's buying $100 million in Bitcoin. It doesn't seem to really make it a significant jump in the price. Whereas with these Ethereum DATs, it's went crazy. It's 3x or 2x in the last couple of months. Kind of talk to us about that side of the things. Like, are you seeing these really boost the price for these assets?
Yeah, like every market, it's supply and demand. So
Yeah.
you've got vehicles that are coming into the marketplace with fresh capital and a mandate to purchase tokens. A lot of them they'll close and they'll buy their entire stash in one go around, and a lot of them will approach the market in a more intelligent way, let's say. But either way, you're talking about a much larger market cap of Bitcoin. So $100 million worth of Bitcoin, relatively speaking, is much smaller than, let's call it, $50 million worth of ETH, right?
Right. Doesn't move the
So,
needle.
and on top of that, you're seeing there are probably more ETH vehicles and more demand for ETH right now from institutions, not just from DATs. So there's a mistaken presumption right now that DATs are kind of fueling all this ETH demand. They are fueling ETH demand for sure. They're coming in every day and they're buying it, and we're seeing it. But we're also seeing institutions who were buying Bitcoin, for example, for their treasuries, are now also buying ETH. Trading desks, OTC desks, are sometimes seeing ETH outpace Bitcoin 5-1 in terms of demand.
Wow.
So this is not just endemic to DATs in terms of demand and moving the market. This is really broader. And as I mentioned before, there's this broadening appeal or broadening of access to crypto that's occurring through the equity markets now, where people and institutions, endowments, high net worth individuals who might not have wanted to trade crypto can now just go in and trade through the equities market.
Yeah.
And so we're seeing, and so you obviously see that coming into the market. How will this end? We don't know. But right now, we're going with the trend.
Yeah. Absolutely. What's most exciting for you on your radar right now, Sam? Any particular, maybe any token shout outs you got? Any just general thoughts about the market?
Yeah, I mean, I'm bullish Sol. We started buying Sol a little while ago. Just from the flow that we're seeing right now, I'm pretty bullish from a demand perspective. Still bullish on ETH. I floated a nice graphic in our internal chat yesterday, which shows year-over-year performance of Bitcoin, ETH, and Solana, as well as the S&P and gold. And turns out that ETH has just recently in the last month, overtaken Bitcoin in terms of performance, although it feels like it hasn't. So it feels like ETH has really been driving returns, and Bitcoin's kind of been slumping. Realistically speaking, Bitcoin, I'm looking at my screen right now, it's 112,000, all-time high of 124,000. So you're talking about what, maybe a 10% decline from all-time highs. Well, in January, that decline was 30% from all-time highs.
Yeah.
And going back to that year-over-year chart, Solana is only up 29% year-over-year. Remember, Solana and a lot of alts are still far below the all-time highs that they made last November. So when I look at that, when I look at some indicators that I like to judge the market by for like overheating and over exhaustion, et cetera, nothing to us is pointing at this is an overbought market and you have to be wary. I think that this market has decent room to run on the upside. But at the same time, I do think that we are coming into that sort of final stage. We just don't know how long the final stage lasts.
Yeah. That's the real question. We'll see. Well, Sam, this has been a lot of fun. Really appreciate you joining us. Thank you for telling us about your background, diving into DATs with us. Where could people go to connect with you and learn more about Monarch?
Sure. So you can find out more on our website, monarq-am.com. That's monarq-am.com. And you can reach out to investor relations at monarch.com or bizdev@monarch.com and find out more information.
That's awesome. Well, Sam, this has been a fun conversation. I'll make sure to include all that in the show notes. This has been great. We appreciate your time.